Not all aspects of your financial life deserve the same level of attention. Instead, if we can learn to focus most of our energy on the most important things, then we'll all be a lot better off financially. Today, we're going to discuss your single most important financial asset and what you can do to protect it. This is another episode of Ready for Retirement. I'm your host, James Connell, and I'm here to teach you how to get the most out of life with your money. And now, on to the episode. Peter Drucker once said, efficiency is doing things right. Effectiveness is doing the right thing. Efficiency is doing things right. Effectiveness is doing the right thing. How can we apply that to our financial planning? Well, I see people who are highly efficient with their financial planning, but incredibly ineffective. So what's an example of that? Well, efficient might be something like categorizing all of the expenses every single night in your budgeting app. You might be doing it right. You might be categorizing those right, but is this going to make a material difference in your financial well-being long term? Now, it certainly helps. It could certainly contribute, but that's not going to be a major factor in your overall financial success. Now, effectiveness, again, effectiveness is doing the right thing. I would relate that in a financial planning term to focusing on the right thing. So what's the single most important thing that most people can focus on? It's our income. Our income at the end of the day is the thing that allows us to consume what we need to consume today, while also saving and investing money for the future so that we can consume what we want to consume in the future. So as we look at it like this, getting that one variable right, it's almost like a domino effect of the more you can increase your income, the more other things will fall into place in terms of your ability to afford things today, in terms of your ability to save, to invest, to do a whole lot of other things. And really this comes down to, do you focus on the $3 decisions or the $30,000 decisions, or even the $300,000 decisions? What's an example of a $30,000 or even a $300,000 decision? Your income. And I'm going to show you how in this episode as we start to walk through this. Quick reminder though, before we jump in, make sure to check us out on YouTube if you've not already done so already. You can find this episode and other content on YouTube at the channel Root Financial. Lots of great stuff there. And also want to highlight the review of the week. And this one comes from username Sal Porter. 5-star review titled Great Information. Sal Porter says, I recently came across this podcast and I love the information shared and how it's explained. I appreciate the detail and examples on really complex issues around retirement planning, taxes, entering retirement, and critical things to take into account. Sal Porter, thank you for that review. And for those of you listening, please leave a review if this podcast has been helpful to you even in the least bit. More reviews helps more people find the show. The more people find the show, the better off everyone is in terms of being prepared for their retirement. So with that being said, let's jump into the episode. And what we're going to be talking about today, again, is how do we protect our most important financial asset, which is our income. I know oftentimes when you think of financial assets, you think, oh, well, it's got to be something like my 401k, which is where I'm building my wealth. Or maybe it's my Roth IRA, because that's going to be tax-free forever. Yes, those are all important, but what precedes those things is your income. And the higher your level of income, the more you can take advantage of 401ks or Roth IRAs or investments or whatever the opportunity is. It all starts with that income, which sounds simple enough, but today we're going to walk through a framework that you can apply to your situation to see how can you protect this income? How can you enhance and make the most of this income? And what will the long-term impact of that be on your financial plan? So we're going to go through 4 things that you should focus on as you're looking at this of how can you maximize your most important financial asset. And these may seem simple, but a lot of the things that are most important in life are simple, yet not necessarily easy to implement. So we're going to talk about the simplicity of this and then walk through what does that look like in terms of the long-term financial effect. So number 1, the first thing that you can look to do is get what you're worth. Now, this is a simple enough starting point, but let's see the impact of this over the course of your career. Now, most people listening to this podcast are a little closer to retirement, maybe even within the next 10 to 15 years or earlier thinking about retiring. But let's take a look at this over the course of your entire career. Let's say that someone starts working at the age of 22 and they're going to work until the age of 65. So let's assume this 22-year-old is going out and interviewing and their skill set is worth, let's call it $50,000 per year as a salary. But this 22-year-old, they don't take the interview process seriously, so maybe they settle for the first job that makes an offer and they get it, but that job only pays them $40,000. Now, as we're looking at this, and I recognize this isn't how it actually works in reality, but if we just play this out as an example, let's assume that individual averages 5% per year increases in their salary from the time they're 22 until the time that they're 65. And again, they're starting at $40,000 per year. Well, if they did that, their final wage, so at age 65, they would be up to $342,000 per year, and their cumulative lifetime wages between age 22 and 65 would be $6.35 million. So again, that's starting at $40,000 per year, that income increasing by 5% per year, and their final annual wage would be $342,000. So it's $6.35 million total. Now, if we assume that same person had instead taken the interview process more seriously and said, you know what, I'm going to go get a job that starts paying me what I'm worth, which is again $50,000 per year. Well, in that instance, $50,000 again would be the starting wage, but that would then increase all the way up to $428,000 by the time this individual was 65 years old. Now, you might be thinking these numbers sound kind of wonky. Hey, that's a very high income for someone starting at that wage. Well, there's also inflation, so keep in mind this is kind of projecting someone that starts at 22 years old today, and by the time they're 65, earning something like this. But again, this is more just hypothetical to illustrate a point here. But that individual that started at 50, had 5% per year increases in their wage base, their cumulative wages over the course of their working career are $7.93 million as compared to the person who started at 40, whose cumulative wages were $6.35. So there's a difference here of $1,580,000 earned over their career just by getting what you're worth from the start. So you start with a higher wage, and then because that compound growth rate is now applied to that higher wage base, it makes a pretty significant difference, almost $1.6 million over the course of a career of extra income. And again, what can you do with that extra income? How much more could you save? How much more would you have to purchase a home? How much more would you have to send kids to college? How much more would you have to save for retirement? That $1.6 million of income could drive a huge amount of change in your financial plan, all by starting at a higher wage base. And in this case, just a higher wage base of $10,000 per year. So this is kind of simple math. 50,000 is 25% higher than 40,000. So by starting 25% higher, it means that your final cumulative wealth will also be 25% higher. And I shouldn't say cumulative wealth, I should say cumulative wages. Your cumulative wages will be 25% higher, assuming the same compound growth rate. However, what if we don't assume the same compound annual growth rate? This plays into point number 2 of how can you protect your most important financial asset, which is your income. Well, number 2, you can invest for compound growth. Now, we talk a lot about investing in compound growth on this podcast, and you've likely heard me use the example before. I've said, what happens if you take a penny and you double it every single day for a month? Well, that penny starts out as a penny. That's not very much money. But if it doubles every day for 31 days, by the end of that month, it's worth over $10 million. So that's the power of compound growth. That's a huge difference in when you look at what that asset grows to when it's compounding on a daily basis. So you may be saying, James, so what? I can't just take my income and stick it in the stock market and hope that it compounds for me. Well, no, you can't stick your income in the stock market, but you can invest in your skill set and your abilities and accomplish compound growth or a higher compound growth rate with regards to your income. What does this look like? Well, this looks like trainings, this looks like certifications, this looks like other degrees, really anything that develops your skill set, anything that you can do to become better at what you're doing. That makes a radical difference in terms of the income you can expect to receive. And let's look at a simple example to show you how. What if doing what I just said, whether it's a training, a certification, attending a Toastmasters, doing a Dale Carnegie workshop, whatever it is, you improve your skill set just even 1% per year, and that extra skill set gets you an extra 1% per year in terms of the wages you can expect to receive. Well, with that extra 1% growth rate, so let's now assume that you can receive 6% per year growth in your income. So if you remember, in our previous example, we said, what if you start with a base of $50,000 per year, and that increases by 5% per year from age 22 to 65? Well, if you had done that, your cumulative lifetime wages would be $7.93 million. Well, what if you had that same exact example, except that instead of increasing by 5% per year, you're able to increase your wages by 6% per year? So seemingly a tiny difference, just a little bit each year, but you compound that over a career. Well, now what you get is now your cumulative lifetime wages are $10.58 million. In the prior example, where your wages were only increasing by 5% per year, but still with the same starting wage base of $50,000, your cumulative lifetime wages were $7.93 million, which means just by increasing your salary by an additional 1% per year, that's an additional $2.65 million you would earn over the course of your career. Again, what does that mean for the home you can buy, the schools you can send kids to, the things you can do for retirement, your ability to enjoy lifestyle along the way? That's a lot of extra dollars, and it was only because of a simple 1% increase in your income relative to what it otherwise would have been. But that 1% extra increase per year led to more than 33% higher lifetime earnings over the course of your career. So you can see how impactful that is when it comes to making the most of your income, which again is your most important asset. So as you look at this, as you can view your income from a standpoint of, yes, I want to compound my assets and my investments, I also want to compound my wage growth. And if I can just get small, additional, extra incremental growth rates in my wage base, that makes a huge difference over the course of a career. Granted, as I'm talking about all this, I know that this isn't really a linear progression. It's not like you go to your boss and say, hey, I get a 1% additional raise over all my other coworkers. Maybe it's every few years you get a 20% raise because you get a giant promotion, or you move to another company that will pay you a much higher wage base. But whatever it is, if you can just average that 1% over the course of a career, in this example, we see that means 33% more income over the course of that career. The third thing that you can do, fairly simple, but don't burn out. So let's look at an example of this. Let's assume that you're already well into your career. Maybe you're 59 years old. Let's assume that at 59, you're in your peak earning years and you're earning a very healthy income, but you're burned out. Your job is stressful, it's long hours, you're not able to do things that you want to do because you're constantly in the office. And you're looking at this and saying, geez, realistically, I can probably only keep doing this for 12 more months. Let's assume that healthy income that you're earning is $350,000. So that's your first option, is work one more year and earn $350,000. Or you look at other opportunities out there and there's one for much, much lower pay, but it's something that you would really enjoy doing. Let's assume pay is 1/7 of what this one is. So you get $50,000 per year, but it's doing something that you would totally love, something that you would enjoy doing, something that would not burn you out. And if you did that, then you could work until age 66. So if you're 59 years old now, working until 66, that's 7 more years. Well, as you look at this, it might seem like the same thing. Okay, you could earn $350,000 all in 1 year by doing this high stress job that's burning me out and get it all at once. Or I could spread it out over 7 years. $50,000 per year for 7 years kind of seems like an equal outcome, right? Well, not necessarily, and for a number of reasons. Number one, $350,000 isn't really $350,000 that you get to keep. If I run this through a wage calculator using an individual living in California, where there's, of course, federal taxes, there's then California state taxes, and there's payroll taxes. Well, someone earning $350,000 in California, they might only take home about $198,000 for the year because the rest is going to taxes. Now, if that individual instead earned $50,000 per year for 7 years, well, if they earn $50,000 per year, they're taking home a little bit more than $40,000 per year. Again, using California as a state that I'm doing this calculation in. If they take that amount home for 7 years, now they're taking home a total of $281,000 after taxes. So you look at this, and right off the bat, they're earning the same gross income. One's doing it in 1 year, one's doing it in 7 years. But the person who spread that out over 7 years is actually taking home an additional $83,000 than the individual who earned it all in 1 year because of being in a much higher tax bracket. So they end up taking home 42% more dollars by spreading it out. So that's one benefit. Now, number two, if you do something you enjoy for work, you maybe don't stop doing it. So oftentimes these things that you enjoy doing, there's no reason to retire from something if it's meaningful, if it's enjoyable, and if it's not taking away your ability to do other things that you enjoy. You might do it longer than 7 years. And again, you're not retiring per se, but you're able to live a great life where work is enjoyable and you have that balance elsewhere. So the longer you're able to preserve that income, which again is your most important asset that we're talking about, the better off you're going to be. So as you look at these jobs where you can earn a really healthy amount of income, but it's going to take a toll on your health and your stress levels, and it's just not sustainable to think that you can do that for long periods of time, sometimes the best thing you can do, not just for you personally, but even for your finances and your income, is to do something that you enjoy doing, because you have greater longevity on that, not as much as taken out from income taxes. Again, assuming that you're earning a lesser amount for doing it. And then the other benefit is if this allows you to prevent yourself from pulling money out of your portfolio to live on, then there's a huge additional benefit of the income your portfolio can continue creating and reinvesting to create even more income into the future. So as we're looking at this isn't just kind of an incremental change in your overall financial well-being, it's an exponential change in your financial well-being. When you start to look at how higher levels of income played out over longer periods of time can have a wonderful long-term benefit to your overall financial well-being. And then the fourth thing that you can do to protect your income is to live within your means. And what I mean by this is you cannot out-earn bad money habits. I've seen so many people that have wonderful incomes, but nothing to show for it. And it's because it's not just about your income, it's about your ability to live within your income. Let's look at it this way. When you first start working, you have a lot of what's called human capital. So if you're fresh out of school, you're worth a lot of money in terms of your ability to earn an income over time. This is called our human capital. What is the potential within us to earn income? Now, as you get older, that human capital starts decreasing. You just have fewer years of work in front of you, which means your level of income that you can continue to generate is lower. And this, again, is because there's only so many more years that you can continue to earn an income. This is why it's so important that you translate that human capital into financial capital. This is exactly what you're doing when you put money into your 401k or put money into a Roth IRA or put money into a brokerage account. Your human capital is what's earning that income. You're taking part of that income and translating it into financial capital. And ultimately, that financial capital is going to build up to the point where it can create an income that fully sustains you without you having to work anymore. This is the whole concept of financial independence and why we save and invest in the first place. So over time, your human capital will go down, but your financial capital will go up if you can live within your means. If not, then it does not matter how much income you earn. If you're not translating some portion of that into financial capital, you're not going to ever be getting ahead. Take a look at Warren Buffett, for example. So what's the value of the work that he continues to do in terms of the income he receives? It's actually fairly low, probably a lot lower than you would expect from the standpoint that he only pays himself a salary of $100,000 per year. Now, why does he do this? It's because his financial capital is enormous. He has taken his income and reinvested that for years and years and years and decades and decades and decades, to the point now that $100,000 to him is a rounding error. He could do without that salary and still be totally fine because he has over $100 billion in financial capital, and that could create more than enough income to make his $100,000 salary almost irrelevant. So to grow your financial capital, you need to maximize your human capital, so maximize your income, but you also need to live within your means so that you can translate that human capital into financial capital where it can then support you for the rest of your life. So as we're looking at this, so often we like to look at tax strategies and investment strategies and all these different things that are very important. But your income is what predicates all of that. If you have a higher income, you can save way more. If you have a higher income, you can invest way more. If you have a higher income, you don't need to make some of those difficult trade-offs sometimes between can I do this or do I want to do that. Having a high income alone will not get you there because, again, as I just mentioned, you need to have the ability to live within your means as well, but it's a great starting point. So number one, get what you're worth. Make sure that your income is justified by your skill set that you have, or at least you're working towards something that justifies a skill set that you have. Number two, invest for compound growth, even within your income. How can you improve your skill sets and your talents and your ability to do your job well so that over time the growth rate on your income increases by more than otherwise would have? Three, make sure you don't burn out. The longevity of that income is as important as the amount of the income sometimes. And then four, live within your means, which isn't necessarily a way to protect your income as much as it is a way to take that income and actually allow you to do something with it to set you up for future financial success. That is it for today's episode. Again, if you're listening and you want more information like this, be sure to check out our YouTube channel under Root Financial. If you haven't done so already, please be sure to leave a review, and I'll see you all next time. Thank you for listening to another episode of the Ready for Retirement podcast. If you're looking to work with a financial advisor that cares deeply about helping you get the most out of life with your money, head over to our website at rootfinancialpartners.com and click Start Here. one of our advisors would love the opportunity to speak with you. You can also find the show notes for today's episode on our website, along with other great content that will help you to create a wonderful retirement. And finally, if you have a question that you'd like for me to answer in a future episode, then from our website, click on the Learn tab. Scroll down just a bit on that page and then click Submit a Question to submit a question that I will answer in a future episode. Again, that can all be found at rootfinancialpartners.com. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice. It is for informational purposes only.